Hi. Let's learn about the capital account in international macroeconomics. The capital account, in international macroeconomics, is the part of the balance of payments that records all transactions made between entities in one country with entities in the rest of the world. These transactions consist of imports and exports of goods, services, capital, and transfer payments such as foreign aid and remittances. In accounting, the capital account shows the net worth of a business at a specific point in time. It is also known as owner's equity for a sole proprietorship or shareholder's equity for a corporation, and it is reported in the bottom section of the balance sheet. Changes in the balance of payments can provide clues about a country's relative level of economic health and future stability. The capital account indicates whether a country is importing or exporting capital. Because all the transactions recorded in the balance of payments sum to zero, countries that run large trade deficits, like the United States, must by definition also run large capital account surpluses. This means more capital is flowing into the country than going out, caused by an increase in foreign ownership of domestic assets. In recent years, many countries have adopted the narrower meaning of capital account used by the International Monetary Fund. It splits the capital account into two top-level divisions, the financial account and the capital account. The financial account measures increases or decreases in international ownership of assets, such as foreign direct investments, securities, and foreign exchange reserves. The capital account measures financial transactions that do not affect income, production, or savings, such as international transfers of drilling rights, trademarks, and copyrights. The current account represents a country's net income over a period of time, while the capital account records the net change of assets and liabilities during a particular year. The current account reflects transactions with a real impact on income, production, and savings, while the capital account reflects changes in ownership of assets. The balance of the current account and the capital account in the balance of payments will always be zero. In accounting, a capital account is a general ledger account that is used to record the owner's contributed capital and retained earnings. It is reported at the bottom of the company's balance sheet in the equity section. In a corporate balance sheet, the equity section is usually broken down into common stock, preferred stock, additional paid-in capital, retained earnings, and treasury stock accounts, which provide insight into the financial health of a company. A capital account in accounting refers to the financial assets that a company is able to spend in a given period. An equity account is the portion that shareholders would receive in a liquidation event, when a company's assets are sold and its debts are paid off. A capital account is important because it shows the flow of investment in and out of a country. Ideally, a country would prefer a surplus in its capital account, as it shows that foreign nations are investing more in the domestic nation, which is better for the domestic nation's economy. As of 2023, the Netherlands has the largest capital account, with a surplus of $112.5 million. The countries following the Netherlands are Spain, France, Italy, and Romania. The capital account, on a national level, represents the balance of payments for a country. It looks at the net changes in assets and liabilities, which provides insight into whether foreign nations are purchasing more of a country's assets or if domestic buyers are spending more on the assets of other nations. Deficit. Here are three key takeaways. 1. The capital account, on a national level, represents the balance of payments for a country. 2. The capital account keeps track of the net change in a nation's assets and liabilities during a year. 3. The capital account's balance will inform economists whether the country is a net importer or net exporter of capital. Hope this would help. Thanks for watching.